My name is Brendan Martin, and I am an MBA candidate here at Quinnipiac University and the co-chair of the VIB team. This key panel presented by Delphian Trading will be covering analyzing growth and opportunities in listed options. The moderator for this session is Joe Burgoyne. Joe joined Delphian Trading as chief strategist in 2020 after spending 11 years as a director of education for the Options Industry Council, the option industry's educational initiative funded by OCC and founded in 1992. Joe started his career on the Philadelphia Stock Exchange options floor, where he spent over 20 years trading the markets and managing operations for two firms, Teague Securities and Van Deer Moulin Options USA. Joe has participated in 10 game conferences. Please welcome Joe Burgoyne. Our next panelist is Russell Rhodes, PhD, CFA, and head of research at EQDerivatives. Prior to his time at EQDerivatives, Rhodes was head of derivatives research at Tab Group, and before that role, director at Cboe Global Markets, where he has had a focus of VIX, SPX, RUT, and cryptocurrency markets. He graduated from Oklahoma State University with his PhD in management, his master's in financial engineering from Illinois Institute of Technology, and his master's and BBA degrees in finance from the University of Memphis. Please welcome Russell Rhodes. Our next panelist is Henry Schwartz, Senior Director, Head of Product Intelligence at Cboe Global Markets. He is an equity derivative professional with extensive experience in marketing, making, sales, and trading, hedge funds, and institutional trading technology. Schwartz is an entrepreneur and innovator with a high degree of industry visibility and extensive network of buy and sell side marketing participants. He graduated from NYU Stern with his MBA and UC San Diego with his BA in economics. Please welcome Henry Schwartz. Our third panelist is Greg Stevens, Vice President, Option Experience at Fidelity Investments. Stevens is a highly accomplished corporate product development and business development leader. Stevens has had an extensive record of success driving organizational growth for leading financial organizations through designing and implementing innovative tools, processes, and service offerings. He graduated from Marian University in Indianapolis with a BS in finance. He has his Series 7, 24, 63, 4, and 99 licenses and certifications. Our fourth and final panelist is Ashok Yarlagada, founder of Delphian Trading. Delphian provides quant managers, investment banks, academia, money managers, proprietary traders, and retail traders with an institutional strength market analysis, strategy development, optimization, and execution platform. Before his time starting the company, Yarlagadda was the Chief Information Officer of Systems Soft Technologies, and prior to that position, client partner at Capgemini. He graduated from the University of Madras with his BE in computer science. Thank you all for being here. As for our listeners, please stick around after this session as we will announce the winners of the Global Portfolio Competition Award Ceremony. Now to you, Joe.
Brendan, great job. Thanks a lot, and welcome everybody. Thanks for joining us on a Friday afternoon to talk options. Quick thanks on behalf of the panel to Quinnipiac University for having us today. Special thanks to Dr. Osman Killick, as well as the Dean Holly Rader. We appreciate the opportunity to talk options. Like all the panels that you've heard over the last couple of days, this one is frankly second to none. We've got Henry Schwartz, Ashok Yarlagada, Greg Stevens, and Russell Rhodes. You heard a really excellent introduction from Brendan on all of them. So I think, how about if we start by, Henry, I'll go to you first. Talk a little bit about your career path, maybe factors that influenced some of those choices, and maybe what drove you to the options business.
Sure, thanks. And hello, everybody, and my fellow panelists who I think are all experts in this. This is spectacular. I was actually pulled into the options world through technology back in the late 80s, seeing a bunch of computers in the garage of a neighbor of mine. And that neighbor was Blair Hull, and it turned out he was using computers to price options kind of before anybody else was. And that got me a little bit interested in what he was up to, and I asked for a summer job and was hired as a runner on the Cboe in the summer of '87 when I was in college. And I was just listening to some of the other panels, and a few of us have been around long enough to remember the crash of '87. I was not working then because I was a junior in college, but I remember getting a bonus check in the mail on Black Monday from Hull, and I was astounded. I was like, "Whoa!" It was a summer internship, and I was like a $2,000 check, and I was like, "This is amazing." And then my roommate was like, "You should see what's going on TV," and the market was down 23%, and I was like, I didn't know options very well, but I did know that market makers blew up in some cases, and so I went to the bank and took out cash, figuring like they couldn't claw it back if I actually took out cash. And Hull actually survived the crash of '87 anyway, and I ended up back there after college. So, and over the last almost 30 years in the business, I've worked at several Wall Street banks, and then about for the last decade or more, I've specialized in options technology. I started a small firm focusing on the data side of the options markets, and we'll actually talk about a few things coming up. But thank you for having me.
Fantastic, Henry. And yeah, to everybody listening, Henry said the market was down 23%. That was in one day back in October of '87. So just an FYI. Ashok, it's great to have you. Tell us your story, please.
Yeah, thank you, Joe. I graduated in computer science engineering, right time, right place, and started making money. And I got intrigued with the stock investing, thought I could make more money. So I invested all in stocks and got burnt in the 2000 dot-com crash, and lost most of the money. So that's why I got intrigued into options and learned options. And eventually, I used all the mathematics that I learned, statistics I learned, and the computer science engineering to my benefit to design a tool for myself, because there was not an existing tool at that moment. This was about 7-8 years back, and saw the gap and thought of doing a startup as a product because there is an existing gap. And I was actually working for a lot of banks in the last 25 years before that, building IT products for them. So that's how I got into options, Joe.
Fantastic. And again, to people listening, Ashok referenced, the blow up of essentially the NASDAQ in 2000, 2001. The NASDAQ topped out at 5,000. I think it was in 2000, dropped all the way down to 1,200 over the course of about a year and a half. So some major movements in these markets, has drawn our first two participants. Greg, you're up, buddy.
Thanks, Joe, and thanks to the panelists as well as Quinnipiac for having me back. I had a little bit more of a humble beginning, than a crash and/or losing all of my money in the markets. I was taking an economics class in high school, and we actually visited the Federal Reserve, where I seen a whole pile of money, looking at me. Plus, we actually went to E.F. Hutton, and listened to brokers talk about what they did from helping investors meet their financial goals. And I thought that was interesting, which led me into my major, which was business and finance at Marian University. But I really got interested in options. I started right out of school at Charles Schwab, and quickly, was, giving quotes on the phone. That's before, the internet was really proliferated throughout the brokerage industry, but just the start of it. And so, started to cut my teeth a little bit there. But then, as I moved through, Charles Schwab, there was this thing called options, and nobody seemed to want to trade them for customers. They were this big, scary thing, and that just drew me to them even more. And ended up driving my career path from there onto, at the Cboe, where I had, a chance to, meet Russell and folks, as well when we were there, and then on to Fidelity Investments, where, now I help design platforms to help investors, trade options. So it was the start of one spot and then all the way to the other. So that's it, Joe.
Thank you, Greg. Fabulous. Russell?
Yes.
Last but not least.
Yeah, well, thank you. So Russell Rhodes, I it's amazing how many people in my generation started out on the trading floor. And it really is unfortunate that, I mean, there's lots of positives behind things going electronic, but one of the negatives is you don't get the experience that some of us did walking into what was almost a sports arena every morning. I started out at the CME group working in the Eurodollar pit, which was pretty massive. Decided I actually didn't like the floor that much, and moved over to moved upstairs on the buy side, worked for a variety of hedge funds for about 20 years. And then kind of late career, I sort of shifted over to education, got a job at the Cboe working at the Options Institute, where Greg is an alumni of as well. Worked up to where I was in charge of that division for a little while. Really liked education, liked doing game forums. I was, if you ever did a tour of Cboe, I was the person that would take you around on a tour of Cboe. So I decided to go back to school and get a PhD at Oklahoma State. And now I'm like half in the consulting space with EQDerivatives, but I'm also an associate clinical professor at Kelly at IU. So I kind of straddle both the education side and the professional side. And then finally, just to give you guys some perspective, that 23% on the Dow, if that happened right now, that would be an 8,000 point drop, which I think is which makes your eyes open a little bit more than the 23% part.
Good perspective, Russell, indeed. So we've got just over 45 minutes, okay? There are four of you. We want to cover a lot of questions. Henry is the man as far as data in the industry. He's very modest. You know, he ran his own business that he built, you know, customers being the big banks, and he would analyze trades in a millisecond that happen on the, you know, in the options market. He's been doing that for a long, long time. He was kind enough to put together, you know, a few slides, which I think we will roll over to. Bear with me just a second. Okay, can you see those slides? Let's see. Can you see them yet?
No, not yet.
Not yet. Okay, sorry about that. I got to. I didn't share the screen yet. There we go.
Yeah,
okay.
you can see.
Beautiful downtown Chicago. Henry, thanks for putting these together. Go for it, Henry.
Okay, thank you. Yeah, and a lot of panels, they just call me the guy with the data. So, and I've been lucky enough to play with options data for the last, really the last 15 years. So I want to go through things quickly, so we do have a lot of time to talk. But a couple of the basic messages that we're going to hit. Okay, so the options market has been around for about 40 years. Over the last few years, we've seen extreme growth, and we're going to dig into a couple of the factors that are going on there. We've seen much wider adoption of options usage, which is really interesting because for the last 20 years, I've gone to conferences where a lot of the panels would be all about how can we get more people to trade options? We don't want the hedge funds; those guys are fine. We want people to trade. And over the last few years, things have just kind of exploded on in terms of participation and adoption. With that is a lot of shrinking trade size, shrinking products. You might hear about minis and nanos and micros. That's a very significant trend that seems to be continuing. And the last big kind of theme is there's a focus on shorter durations. People like to trade options that expire within the next week. Okay, even though there are options now listed out several years, it's the activity is really focused in these short-term weekly options, which have only been around really for about 10 years. So let's look at some of the data. What you're looking at here is total option volume per year since options were first listed on the Cboe back in 1973. And the box on the left shows you the emergence of new exchanges. Okay, so there's now 16 exchanges, but for the first 20 years or so, there were only 4: the Cboe, the Amex, the Philly, and the P-Coast, which is now NYSE Arca. And a couple things to see is you can kind of see the growth was kind of modest for the first 20 years or so, 73 to almost 30 years. And around 2000, things really start to change. And what's really interesting is I watched the panel today when the Women in Finance with Geraldine Endo, and then the crypto panel with which Janine Hightower was on. Both of those women worked at the ISE, which launched in 2000, was the first truly electronic options exchange, and truly changed the game. And that's the reason that you see this kind of exponential growth through the 2000s. You also had the dot-com bubble imploding. You also had, a lot of activity, but the emergence of truly automated trading is really what got us from the 500,000 contracts a year to 4 billion contracts a year, which is kind of where we hung out for almost a decade. And then, so that would be another topic at these conferences. People would be like, okay, how are we going to get out of this 4 billion contract a year funk? And then you see what happens in 2019 and 2020 and 2021. Volume explodes, and this is coming from a couple of factors, but one of them is the emergence of zero-cost brokerage accounts or low-cost brokerage accounts. So the commissions, which had been sliding lower, basically kind of bottomed out and near zero. And then you also had the COVID-19 work from home dynamic, which gave people with disposable income more time to trade. Maybe their bosses weren't looking over their shoulder, so they got into options trading. And that's so what we're looking at now. This is as of last week. The forecasted volume for this year is almost 11 billion contracts. So zooming into the average daily volume, okay, not annual. You see kind of on a quarterly basis, you see the same kind of thing, but in this slide, we're breaking it out by index options, ETF options, and stock options, okay? Index options is the dark blue bar, relatively actually consistent around 2 million contracts a day. That's primarily SPX and VIX, big institutional hedging products. ETF option volume has lifted, notably since 2018. A lot of that is coming, that's SPY and Q and all the ETFs that you've heard of, but it's also a lot of new ETFs that have been listed over the last year. We had about 1,000 ETFs added in the last 2 years. A lot of actively managed and things you've heard of that are strategy ETFs. Single stock though is the story. That blue line is what kind of blew everybody's mind over the last few years. Single stock option volume has basically tripled in a couple of years. And that was something we would talk about at the conferences, like how can we get interest in this? Because ETFs had been kind of taking over. This slide shows you kind of where this volume is coming from. So option trades come in all sizes. Single contract trades, the smallest possible, to big old, $100 million blocks. This is breaking out the activity by size. And so the top two lines, the green and the blue line, are the smallest possible trades. So trades 1 through 10 contracts, or and then 11 through 100. That you see that activity going from barely 3 million contracts a day to basically doubling over a couple of years in both of those. So that's where the growth has been, a little bit in the 100 lots to 500 lots. But you notice the bottom lines, which are these big institutional trades, the hedge fundy type of trades I was talking about, they've actually decreased at the same time that the market volume has kind of exploded higher. So that's a real sea change in the industry, because it means that the hedge funds are either they're not trading as much or they're trading differently. And this small activity is what's picked up. We can go to the next slide, Joe. So this is, as I mentioned, kind of zero cost brokers really changed the game. And the top, so you're able to, some data is made public in these 606 filings and things that are released. So what I did here is basically tried to kind of get apples to apples across the retail brokers that publish some statistics. And you can see that Robinhood basically goes from barely 8% at the beginning of 2020 to almost 12, 13% kind of in the middle of 2021. And keep in mind, they didn't exist back in 2017. They came from nothing to dominate the market in terms of this retail activity. There's some pros and cons on that, and maybe we'll get into it. And then you can basically see a lot of the other brokers, a little bit more consistent, but it's kind of there's some ebbs and flows as the market moves around, and different brokers kind of concentrate on different types of clients. Total listings, this is kind of an interesting one, and it actually leads into some discussions about technology, and there's some good and some bad going on here. The black line is the number of things with options, tradable options on it. So stocks, ETFs, indexes. Like I said, indexes is just pretty much a limited little game. The growth there from on the right scale shows you basically we went from about 4,300 stocks, ETFs, and options with ETFs and indexes with options to almost 5,600 at the end of the year. I think now it's around 5,700. So huge growth in the number of things you can trade options on, and that's actually an incredibly good sign because it had been sliding lower, and actually the number of stocks listed on the NYSE and the Nasdaq had actually been trending lower. You had all this talk about private equity kind of displacing the whole IPO process and all this kind of stuff. That kind of reversed there, between the issues of SPACs and creation of new ETFs and just IPOs of some of these names you've heard of, things like Uber and Lyft and all these kinds of things. Huge growth there, and it takes you to a point where there's almost 1.5 million options to trade. It can be good and can be bad. Concentration, so there's 5,600 stocks available, stocks, ETFs, and indexes. The top 100 make up about 80% of the volume. So that's like instead of the 80-20 rule, we're talking about the 82 rule. 2% of the names trade almost all the volume. This has actually gotten better. I think that 2018 title is wrong. I think this data is more fresh. But the entrance of retail into the market has broadened out what trades. So there used to be almost 1,000 names that just did not trade. And that was about 25% of the listings. That's shrunk because retail actually kind of wades into new products, different products. Next one, Joe. Short dated shift. I mentioned this as one of the themes. Options used to be a third Friday thing, right? Third Friday, and then they went out several months after that. They came up with weekly options about 10 years ago, and that's the bottom blue section is the 0 to 10 day contract. It used to make up 20% of the flow. Now it makes up almost 50%. And in some stocks, it can be 60% or even more. So Amazon, Tesla, some of the names that are very, very popular for people to trade in and out retail, you can see 50, 60, 70% of the daily volume in these very short dated options. And as students kind of studying the market, I remember when they listed the weeklies and I was terrified because I was on the kind of the other side of this where we were kind of reactive traders as a market maker. And short dated options have a lot of hair on them, there's infinite gamma and very hard to hedge and all sorts of, it's a different game. And the market has really embraced it, and the liquidity providers seem to have gotten very good at trading them because they're incredibly liquid, a lot of activity. And I think that's it for the slides, right?
That is it, Henry. Well done. And attendees, you will be tested on Henry's presentation there. A lot of information for sure, but clearly one hell of a dynamic industry. And let's get to talking about it with the rest of the panel. Greg, how about if I start with you? Let's talk options, just the product itself. Are they risky? Are they complicated? What do you think?
Well, I mean, the simple answer is it depends. And when I say that, I mean, it depends on how, the investor uses. There's a lot of flexibility in options, different ways to structure your investment, different ways to go about using them in order to hedge, to generate income, to invest. There's also speculation. So can they be risky? Yes, but walking out front door some days is a risky adventure as well, right? So it all depends upon how the end user decides to use them. For example, I mean, if you're selling cover calls against the stock that you own to generate a little bit of income, that can be fairly conservative. On the other side, I mean, if I'm using 100% of my investment to buy an expiring option, hoping that I'm going to make some money, it can be very risky. But and then on the opposite side of that, the complication comes that if I'm selling cover calls on a stock that's falling, then I can still lose some money. So yeah, I mean, it's it can be complicated, but options do tend to 1 + 1 = 1, and understanding the basics of those and the structure of how you can use them in order to invest to generate income is a big part of this.
So Ashok, how about your take on the option product itself?
Yeah, they're definitely risky from a point of how much knowledge you have, right? So ignorance is very costly in this particular instrument. And it is definitely a complicated instrument. You need to understand a little bit more math. And more than that, adding to what Henry said, right? It's a zero-sum game. I mean, so there's always if you want to trade options, you don't need another side of the equation. The market maker stands for it. But net at the end of the day, the buyers, the amount buyers are putting in should be equal to the sellers as well, right? So that means there's always, you can be right on the direction, but you structured the strategy wrong, then you could lose money. But there's always that money is being lost to another winner. Like it's like same as a cards game. The money gets settled on the same table, right? That's how I look at it. So, but there are also defined risk products as well. Like you can structure it as a defined risks, like how Greg structured it with a goal in mind. So that's less riskier than the speculative trades where you want to hit a home run always, and that's more speculative and which is more risky.
Very good. Russell or Henry, anything to add with regards to options themselves?
Nothing in particular. I mean, they're like a couple of guys have already said, they're something that you need to spend some time with and dig into and have a mathematical understanding of, but then also understand the price behavior of them. Just like what was just mentioned, that you might get the direction correct on an underlying, but that does not necessarily mean that the option trade that you put on, like let's say you buy a call because you think a stock's going to go up. If it doesn't go up enough, it doesn't go up quick enough, you might have been right in the long run, but that didn't help your pocketbook very much. And I think Greg will probably shake his head in agreement on this one, because we were both at the Options Institute at Cboe. That was probably one of the most common questions we'd get. Stock went up. Why did my call option go up in value? Well, and you learn about that in the textbooks that you have, but actually seeing it and experiencing it in real time is a completely different thing.
Do you know, Russell, I always said that was Henry's fault. It's the market makers taking the money from you. It didn't work out right. But no, I think, Ashok, you mentioned it, just one thing to add, Joe, education. I mean, you need to understand the product to better understand what the pitfalls of any given strategy is. And that goes not only for options, it's, equities, ETFs, cryptos, and so on. So a better understanding gives you definitely a leg up on understanding this stuff.
Let's roll into one of the topics that Henry touched on in his slide presentation, the whole idea of retail expanding. GameStop in 2021 seemed to be such a big part of the markets. Russell, your thoughts on GameStop and actually all that was going on in 2021?
Well, I think the GameStop situation was kind of a poster child for the increase in retail volume and a feeling, and I don't know if I necessarily agree with this part of it, but a feeling that the retail traders were going to, take over, as they like to put it, control of the market. And the press kind of grabbed onto that for a couple of months, and then they moved on to a different story. But I do know from the work that we do at EQDerivatives, we speak to a lot of the bigger trading firms with respect to either volatility or straight up equity derivatives. And we do our outreach in March of each year. So we're coming to the end right now. And I've been talking to an awful lot of desks about any of the changes that they've made. I more than once, looking through the notes of all the different people that do the outreach, we've heard that the professional firms are paying more attention, not necessarily to the retail trading flow, but to those names that have dramatically increased in volume because of that increased trading flow. And then, so I think that had a definite impact on the industry, or that we're at least paying more attention to single stock names. And you see that showing up in the volume as well. So that increase in activity in the single stock options, it wasn't just retail, it was a combination of retail and institutions latching onto retail activity.
And Henry, you spoke to, zero or very low commissions, as well as people, working from home with COVID. Any other thoughts, insights into the explosion?
I mean, well, what we're seeing is much more day trading of options than was ever really possible. The one thing I would say, asking are options dangerous? I consider, like, I tell people it's like a power tool, right? Like, it's very powerful, but you can cut your finger off if you screw up, or leg if it's like a chainsaw. But the one thing, but when you keep things simple and you do something that you just need to understand a couple of basics to try a small trade or paper trade and make sure you understand the dynamics. But one of the volume spike, one of the factors in the volume is because the commissions are so small for a lot of traders, zero for some traders, and also because in these super liquid names like Apple and Tesla, the bid offer can be a penny. That means that I've seen people, we may see 5,000-6,000 contracts trade. We see the price action. We see, okay, somebody started buying calls at 30, 40, 50 cents. And then later in the day, they're selling them out for 35 cents, 40 cents. And that never really was very feasible when people were paying commissions that were a couple of pennies per contract. And the bid offer was a nickel or an eighth or something back in the olden days. And so when you look at the volume as a factor of the change in open interest, which shows you kind of how many positions are actually being opened and managed, the volume has jumped. The open interest has increased, but not nearly the level that the option volume itself has grown. So there's a lot of scalping. There's a lot of playing around, which is not as dangerous as it used to be, just because of the fact that commissions don't kill as badly as they used to, and the bid offer is really compressed in a lot of the highly liquid names.
Makes sense. Okay, the panel is growth in the industry and opportunities in the industry. Let's talk in terms of the opportunities, for our graduates, upcoming graduates. Let's talk jobs. What kind of opportunities are out there? Maybe is there an ideal curriculum of study? Greg, start us off.
Yeah, I'll go at it from the Fidelity investments, the broker side of the business, what opportunities are there, and they're wide ranging. I mean, everything from working in a branch office across the country to one of our investment centers where you're taking phone calls and helping individuals, meet their life investment goals, to what I do, which is a little bit more on the management side, product development. So there's a wide range of job opportunities really to fit, your need. I mean, Fidelity, I'm sure, as many other firms, have, what we like to call, the investment arm, which, goes out and looks for new opportunities, and so it's really, I mean, it can be as broad and inviting, as a career as you can have. I mean, the primary thing is to keep flexible, when it comes into this. I don't know that, from a Fidelity investment standpoint, I've worked alongside philosophy majors, to business and finance, as well. And it's just a matter of, what your interest is in, and then looking for the right opportunity for yourself. I mean, primarily you're working in the finance industry. I had a double major with business and finance, as well as a minor in marketing. So it kind of led me down that path a little bit. And that's one way to go, but I don't think it has to be the only way if you're interested in finance. And I mean, the last thing I'll leave, and like I said, I mean, there are a tremendous amount of opportunities within Fidelity to go a lot of different ways, from marketing to to helping individuals out. But I did want to leave, folks with this. If you're interested, I mean, there's, two approaches. One, we do have internships, and unfortunately, I believe most of those are, filled up for the summer already. But if you go to jobs.fidelity.com, you'll see, you'll see all the jobs that are available for those who are graduating, who might be interested across the country. But also there is a student section. So if you're interested in an internship, something to take a look at now and try to get your name in the door early for those opportunities that come around the following year, or that may open up if there is something still available. But Yeah, that's what I'd say there, Joe.
Excellent, Greg. And Russell, you come at this from a couple different perspectives. Your passion for education, you're right in the middle of it. What are your thoughts?
Well, with respect to within the option industry, even if you're in this day and age, and I'm thinking about this from a professional standpoint, traders have to at least understand programming, if not be able to lightly program. Went through my background about mid-career. I went back to Illinois Tech and did a master's degree in financial engineering because there were things that I wanted to try to do within the markets that I didn't have the capability of doing anymore. I just had not kept up technology-wise. So I learned to program, and traders that program are a rarity within our industry. And then the other thing, when you get into the markets, there's a gentleman named Ed Thorpe, who I think all the older guys here have heard of before. I had the opportunity to interview him once. He's very successful within the financial markets. He also was a pioneer in counting cards. But when I had a chance to talk to him, I offline, you always try to sneak a question in. And my question was, what are you looking at in the markets right now? And he said, well, I'm always trying to look where other people aren't looking. And once you get into the industry, pay attention to things that are relatively new. I mean, if you're going to try to trade S&P 500 index options, there have been people that have been doing that longer than you're alive. If you take a look at trading weekly options when they were new, people may have only had a year or two advantage on you. And my story behind that one was when I joined Cboe in 2009, none of the other people in the Institute were really paying attention to VIX. And I just kind of latched onto it and got kind of lucky that it became a pretty popular instrument. And it had a very beneficial impact on my career. But look in places where everybody else is not looking, so you can maybe make a niche for yourself, as a piece of advice I'd give you as well.
Excellent. Ashok, your perspective?
I think learning derivatives needs more attention. I think if you are looking for a career path in the options industry, there are plenty in the hedge fund world which are coming up because, as Henry also showed, there's little interest or not much interest in the hedge fund world, right? And because of the daily maintenance that is required in the option strategies, that was a primary cause, why there is low interest from the hedge funds. But they're also using those for hedging the portfolios, especially in the market like this. Where there is a 5-year run, 6-year run, bullish runs, long runs, the risk is higher, and so they want to protect the portfolios as well, right? So if you're managing the risk management techniques, there is one good career path because that risk management technique is needed for a long time, always, right? So there is a good career path from that angle as well. More than the investment strategies, risk management becomes a much more premium career.
Thank you, Ashok. And finally, Henry, like Ashok, you had your own business. What are your thoughts?
I think that being very flexible and kind of evolving with the market. If you're interested in finance, things change very quickly, and everybody that I know that is still in the business started in this business when it was kind of easy to make money. There were some structural reasons where honestly, as a market maker, if you stood in the right place, it was hard to lose money. But then that got harder and harder, and a lot of people had to reinvent themselves. And so what I did was basically left kind of the trading world and got into the technology world because I liked it. For one thing, it's important to pick something that you like, but there were challenges, that there were struggles, and people needed help. And so it's a little bit like I spent half my time educating people into kind of how the world works, how the trading world works, and what we created was tools that helped people do their jobs as the jobs were kind of evolving. So, my kind of biggest tip would be that there are still tons of challenges in the industry. You have to kind of, take some time to learn what's going on and then try to figure out wow, there are problems people haven't solved. I mean, like Ashok said, the risk management is still an art, right? And therefore there's all sorts of different ways to tackle that. Trade engineering and where I see some exciting stuff is applying AI to the massive amounts of data that come out of financial markets, and just trying to kind of automate some of the pieces that are still sloppy, I guess would be my tip.
Okay, beautiful. I'm going to ask you guys one more question about your favorite book, and then last 15 minutes we're going to go to student Q&A. So, Ashok, do you have a favorite book on options?
Mine is Options as a Strategic Investment, Macmillan.
Okay, Greg?
Well, Ashok took my first one. Love Larry. But it's also Sheldon Natenberg. I think his options pricing and volatility kind of set the standard. I mean, it's a fantastic read, fantastic book. Amen. Thank you, Russell. Yeah, it's a great book. It's the one I like.
Okay, Russell, Greg took your response. But,
they both took mine. I had one sitting here in front. In a slightly different direction, and unfortunately, I usually have a copy of it close by. A good friend of a lot of ours, I think we all know him, Brian Overby, wrote something called the Option Playbook, which it's basically, it looks like a notebook, and you can see all the different spreads, and it describes why you would use the spreads. But it's a very, very basic book. And I know that at some brokerage firms on the option help desk, everybody has one of those. So when people call up and say, I'm doing a bear call spread, they can turn to the bear call spread page and just have the payoff in front of them. So not my favorite, but way high up there, and in a really good book when I have students that are struggling in derivatives class with option strategies as well.
Yeah, really beautiful in its simplicity. So
Yep.
Good one, Russell. Henry, were you grabbing for one?
I did. I have the John Hull options book, which is my favorite, but the Macmillan book is pretty good. The Natenberg book is pretty good. You know, and the truth is, what I would say is play with they give you formulas, they give you examples, put it into Excel. I mean, the technology that is out there now for free is so much better than it was 15 years ago. You can actually look at something that says, wow, okay, it says that, you know, that this option had this implied volatility. Write a spreadsheet and see if you can actually back into it and see how it works. I also love all of the books about like the scams and flash boys and kind of all about the nitty gritty of some of the games that go on, and they're exciting.
Excellent. We're right on schedule. We're going to student Q&A. I have the first one here. Russell, I'll come to you. Since we are students with small amounts of capital, do you think it's a good idea for us to invest in listed options?
Yeah, I do. And again, I'm in the classroom an awful lot. I was at Loyola here in Chicago, and now I'm at Indiana. And right now I've got about 100 undergrads, and there's probably 3 or 4 that are always talking to me about their option trading. And they're a couple are using Robinhood, a couple are using Interactive Brokers. But I don't think it's terribly dangerous as long as you're asking the right questions. You are willing to ask questions when you feel like you're 90% sure about something, but not 100% sure about something. And that's kind of what I do for some of my students. Something else that, and I don't know what the permission levels are like from brokerage firm to brokerage firm, but I've always felt like the best first option trade would be a covered call. But you need to be you have to own shares and sell a call against that. I've always felt like a very close one, or one for people that don't have an awful lot of capital, is putting on a vertical spread. You either buying a call, selling a higher price call, selling a put, and buying a put with a different strike price, but having a defined risk and reward. I think it's very useful, but also you have a real position on, so you're paying attention to it. So the answer is yes. Just make sure you're not risking a whole ton of money, and make sure that you have defined outcomes, like a worst case scenario when you put trades on.
Very good. Ashok, I'm going to ask you the same thing. Small amount of capital, it's a good idea, to use listed options.
Sure. I'll pick on one comment that Russell made, right? The defined risk model. I like in the money bull calls, slightly in the money bull calls when your account is pretty small, because again, going back to that risk management, if you're able to manage the risk, you will be winner one day, right? So going by that, you should never risk more than 2 to 3% in one single position. So that way you're diversifying the risk in terms of positions as well, and you're using money effectively. And at the same time, overall risk at any given point in time in a portfolio should not exceed more than 20%, 15, 20%. And the bigger the account becomes, I drop that to a 10%, 5% portfolio risk, right? Because I mean, if you're wanting to do a speculative trades with a small account, I mean, it's like a speed. I mean, going in a speed car at the age of the students, right? It thrills, but it can kill as well, right? So that's how I look at it as a small account options trading.
Excellent, Ashok. I love, the black and white percentages there. Greg, coming to you next. Another student question. What are the advantages of buying options over more common investments?
Yeah, I mean, I think this really builds on the last question as well. I mean, it's flexibility. I mean, options give you a lot of different choices. When Russell and I were back at the Options Institute, we used to show a slide that I think Jim Bittman, actually created, Russell, to take us back a little bit further, that showed, 25 strategies, that you could use with options when there's only 3 with stock. You can buy a stock, you can sell short, or you can put that money into a T-bill. Those are your 3 real choices when it comes to just, regular stock investing. But, both Russell and Ashok, mentioned that, you can do, bull call spreads, you can do in the money spreads, you can, customize it to meet your needs. There's cover call writing, there's buying options, there's iron condors, butterflies. If nothing else, this industry has some really colorful names, for the different types of strategies we have, but it really is the flexibility. It's not the only thing you do. I think, we Ashok just mentioned, the percentage of your portfolio that should be, within options, this should definitely be a part of your overall investment strategy because it does give you that flexibility. And even if you own stocks, there are different ways to hedge, your portfolio to the individual positions, and options really, that's the biggest advantage I can give you folks, is that it is, besides, a lower entry cost in some ways for the investment that you're looking to put on, it is the flexibility that it gives you in order to, construct, your investment.
Thank you, Greg. Henry, your thoughts on the advantages of options?
Sure. I think everybody should trade some options. Like Greg said, or Russell said, covered call is a nice, simple strategy. We have, you'll get some 20-for-1 stock splits in some of these high-priced names this summer. So, that's one little barrier, is you got to have 100 shares to trade a regular listed contract. There are smaller products out there. Like I said, things are getting smaller, right? There's some instruments don't split, like indexes don't split. So what they come up with is either a reduced multiplier version. You got to be very careful. Sometimes the market's width is a problem. So you got to understand as much as you possibly can. But the other thing is that I would say is use some of these idea generation tools. I know Fidelity has it. Most of the big brokers have it, where you basically say, okay, I have an opinion on Facebook. I'm, moderately bullish for the next 2 months, and I think it's going to go from here to here. And then you say, okay, what trades actually reflect that view? You used to have to figure this all out by hand. Now, basically, most platforms will help walk you into the trade. It'll show you the payoff profile. You want to make sure you understand everything, but complex orders, spreads, there's all sorts of crazy names for them, but they are the way to trade options with defined risk, right? And the other thing I would say is, especially over the last few years, listed options are generally very efficiently priced, okay? Especially if you stay with names that are, liquid. And what that means is you're not going to find any bargains. You're not going to find anything that's crazy overpriced. Even if you look at, GameStop 200 strike calls today. By the way, Russell, the stock's up 50% in the last 2 weeks, so maybe it's all happening again. That price is not necessarily a crazy price. I don't think there's any crazy prices out there. You have to respect the market. But the good side of that is that I think it's a very efficient risk-reward world. So if you look at a trade and you see what the reward is, and you figure out what the risk is, there should be a connection there. It should make perfect sense. Like, okay, yeah, whatever, this trade costs this much capital, and I could make this much. And if it's a whatever, risk $2 to make $8, that probability is probably around 25% that you're going to make the $8. And you need to kind of respect that and be very realistic about it, and then trade small, like everybody said, and start to get used to the product. And I like what Russell said about some of these things are new and people don't know what they're doing. There's some overlooked types of trades that I think, one thing that's happened in the evolution of the market is the liquidity providers tend to be these multi-billion-dollar firms now. They don't care about little, nickels here and there. They care about kind of the bigger picture. So sometimes you will see a trade, you'll be like, hey, do the math, figure it all out, and you'll be like, that's actually an okay trade. and you can find them if you look around.
Excellent, Henry. We get a data question coming through the chat. So I've got two wonderful data pros here with Ashok and Henry. Ashok, I'm coming to you here. How does data and statistics play a role in options, and how can you start with little money?
Yeah. In terms of the flexibility, I mean, we all learned like options give you a lot of flexibility, right? If you understand statistics, the basic standard deviation and the confidence intervals, then that's what the techniques that are used by the tools to suggest the strategies, like Henry pointed out, right? If I'm bullish on the stock and if I'm not so much bullish, it automatically identifies the strategies. So if you don't understand those standard deviation confidence intervals and how it impacts the options, then you can't structure the options trades. So the data can be well tested, and right now tools like Delphian or some of our competitors, like they have all the mechanisms to show the numbers as well. If you take an Apple stock, like it can show like what the with a 95% confidence level, what would be the price range on the top side and the bottom side as well, right? That doesn't mean it is 100% accurate, but it is 95% accurate based on the math, right? And that is true. Like mathematics can help. Like on top of the artistic one, the quantitative will support your trading strategy.
So Henry, data and stats, how do they play a role in options?
Well, in terms of the job world, the data that the options market produces. When I started my data business, which was 15 years ago, we were averaging about 1.5 million trades a day in the market. We're now up to about 6 million trades on a busy day. The volume has gone from 10 million contracts a day to 60 million on a crazy busy day. I'm predicting we'll see 100 million contract day this year. That's my big prediction, Russell. So data, the amount of data is insane, but it's actually kind of, you can get your arms around it, especially given the new tools that are out there. Somebody's asking, what did I use for the charts? I used Excel, but Excel can now handle 1 million rows of data. So getting comfortable with what the data is and the messages you can get out of the data, I think are crucial. I mean, one of the things that we kind of came up with that people really appreciated was taking these bursts of activity of option flow and putting them into the form of a single trade, and somebody saying, oh, somebody just bought 2,000 calls, but they did it in like a shotgun type of order, and taking that data and saying, oh, well, we know how the market works, and this is very valuable information for people to know, honestly became a business, because we started applying that to the entire market and trying to see what we could see. And the data is really what built my business, right? I'm not saying the data is going to predict what's going to happen, but you can't possibly make a good, educated judgment about what's going to happen without actually looking at the data as well.
Very good. Let's see. We got 3 minutes, and I want to give each of you a chance, to offer your recommendations, advice. But before we do that, Greg, quick question for you. What's the future of listed options, with trading apps, like the Robinhood, Fidelity, TD Ameritrade? Any feeling about that?
I think it's going to continue to grow. I mean, the new entrants in the market. I think this is, still an untapped market. I mean, even, all the, the data, that Henry's, given us at this point, I don't see that, that we've tapped the full potential, of the options market. And with that, I continue to think that there'll be new entrants, that are pushing, existing broker dealers, to do more, to become more, for the individual investor. And yeah, I mean, I look forward to continue, in the future. And 100 million doesn't seem out of reach there, Henry.
Wow, it sure sounds crazy though. 100 million. Anyway, Russell, one for you. What do you think is the riskiest option and why? Kind of a crazy question.
I want to comment on the 100 million real quick because I think Henry's fudging a little bit. We're going to have a bunch of high price stocks like do 20-for-1 splits. So doesn't that just mean that we're going to do 20 times? Yeah, all the experienced guys just cracked up at that one. So, and Joe, you got to repeat the other question because I was trying to be funny.
What do you think is the riskiest option and why, Russell?
I don't think it's I don't necessarily think there's the riskiest option, but I'm going to add a word to the question. What's the riskiest option trade? And the riskiest option trade is selling uncovered options. And it's something that most brokerage firms will prevent beginners from doing anyway. But even if you're allowed to do it, and I've been around, again, a lot, most of us have been around a lot longer than the people that are watching us today. If I want, my broker would let me sell uncovered or naked options, as we like to put it. I don't even want the ability, because if it's the trade, it's the one that I think Greg mentioned, Greg or Henry mentioned the books about the different financial scandals and the blowups and things like that. Everybody finds those really interesting, but just about all of those instances have something in common. It is a complete lack of risk control around whatever trade they were involved in. And short options would be way, way, way high up on that list.
Amen. Russell, I'm going to come right back to you guys. Maybe 30 seconds each. Any guidance or advice for our students today? Russell?
Sure. Just, make sure you understand how to, all of you seem to know how to use the technology fairly well, but an understanding of technology combined with an understanding of the market structure of financial markets, it will go a long way for you within your career.
Super, Russell. Henry?
Well, I would jump in. I think the most dangerous trade is over leveraged. I've gotten whipped in thinking that I know how to trade futures, and futures are just a very high leverage product. So be careful, because it's very easy to get tricked into doing something that is too big. My biggest tip for employment in the industry is try to get a good handle on how everything works. I agree absolutely with Greg. I think that the evolution of the brokerage space is very exciting because you have new participants, shaking things up, doing things that 10 years ago people would have been like, oh my God, I can't believe they're letting people do this kind of a thing. But everything's moving, and it's awesome to kind of see this evolution, and it is leading to incredible amounts of volume. Russell, I was not assuming that the 20-for-1 splits would get us up there. Maybe the nanos if we get 10% of the SPY volume, but and ask as many questions as you possibly can. Don't think that it's embarrassing. You just ask, bug people, and you will learn.
Ashok, your thoughts?
Yeah, Joe, I don't think there is a risky option trading. I do agree that naked calls, naked options are riskier, but the more riskier is, or what's riskier is for a young student, there is a lot of marketing in the world which talks about 300% return, 400% return trading options, right? So listening to them and learning from them is the more riskier one. Look for more consistency and show me okay, how can I do 80% of the times, 25% winning, and it's a raindrop strategy that makes long success, right? You can sustain that one rather than looking for the home runs, which you can do only once in a while. And defining success, right? How can you define success? And you can define that comes from making decisions, and to make decisions, you need experience. And how do you get experience when you're a student, right? By making wrong decisions. So it's a chain of making wrong decisions and doing practice, practicing using the backdated data and doing a lot of back testing and designing strategies, how it would have been, how the market would have told me, because market is the biggest guru. And if the market told me like it didn't work in the past, it's most likely not going to work in the future as well, right? So that kind of practice and putting time into it is what it will eventually make you successful. Like, so it's always less costly to learn from other people's experience and the world data rather than trading your own money and learning it hard way, right?
Excellent, Ashok. Thank you very much. And Greg, you'll wrap it up for us.
Yeah, I'll just keep it short. I think, what the other, folks on the panel said, is all true. I think, I'll just take it from the career standpoint. If this is your chosen business, be flexible, learn the business, explore different, career paths, within it. I have, and, I ended up settling, I like derivatives and product development, and that's where my passion lies. But I think, flexibility, is key to, determine if this is the business that you want to be in, and, take on many roles and learn, and have many new experiences. And I think you'll end up in a good spot there. So with that, Joe, I'll turn it back over to you.
Wonderful, Greg, and panelists, thank you so much. Brendan, we appreciate the opportunity, and I'll turn it back to you.
Yeah, so thank you to all the attendees who decided to come out and join our game forum again. This is my 4th and final year, and this is actually our last session. So I'll be signing off for not only the last member of this game forum, but for my entire stay. So thank you again to this panel. It was great. You guys are very engaging and very informational, one of the best that I've listened to. So I thank you for that. And thank you for everyone for coming out, and hope you have a good rest of your day.